Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we are covering the topic of types of bank. All right, and we have covered several types of banks so far, like the commercial banks that we had covered. Second one was the cooperative banks that we had covered. Third one was the regional rural banks we had covered. Fourth one was the payment banks. Okay. And the latest bank which we had covered in the previous lecture was the small finance bank. Small finance banks. Okay. So basically we had discussed these types of banks in detail. We had gone through a various, you can say the phenomena related with these banks. Okay. Provisions provided in the Banking Regulation Act 1949 regarding these banks. Okay. So I hope that you revise those lectures carefully because as I have told you, these are for your own benefit. All right. Okay. So basically in this lecture, we are going to start with another important type of bank, and this bank is known as the foreign bank. All right. Known as the foreign bank. Okay. So the foreign bank is also an important bank from the commerce and the financial perspective. All right. Why I'm saying this? Because these are the banks which invest in the economy. Okay. And their investments are generally brought the foreign currency. Okay. And how it is possible? We will see this in this lecture. All right. So with this note, let's start this lecture. The first is the little bit overview, or you can say the introduction or the overview regarding the foreign banks. The Reserve Bank of India regulates the operation of foreign banks operating in India to ensure their smooth functioning, compliance with regulation, and stability within the Indian banking sector. All right. However, the foreign banks are belong to the other countries. All right. Foreign banks are generally belong to the other countries. Okay. Suppose this is America. This is India. Okay. America had the bank called Citibank. The America had the bank called Citibank. Okay. And Citibank also has the branches in the India. All right. So the Indian customer who is using the bank will be using the banking services as the foreign banking services or services provided from the foreign bank. Whereas the person who is living in the country of America, and if the person is using the services of Citibank, then it means he is using the service of the domestic bank. All right. I hope that you have got a little bit idea about it. All right. But if the same person is using the services of SBI, which is the Bank of India, then it means the person is using the foreign bank. Okay. So just try to it simplify it. Foreign banks are those banks which are operating in India. Okay. But not incorporated in India. Got it? It means that they are allowed to do their business in India, but they are generally not the banks which were established or incorporated in India. Okay? So that they are called the foreign banks. It means that their headquarters and their establishment belongs to the different country, but in India they can do their banking business. All right? So now let's move forward. First step in the understanding of the foreign banks is to understand the licensing and the entry. Okay, why I'm using the term entry? Because as I have told you, these banks were not registered or not established in India. All right, like as I had provided you the example of the Citibank. Okay, Citibank belongs to the country of United States of America. Okay, the Citibank was not registered or established in India, but you might find their branches in Delhi, Mumbai, okay, in Kolkata, and other major cities or some medium cities, you can say. All right, so these cities lies in the country of India, okay, and the bank belongs to the America. It means that somehow the Citibank had got an approval to enter into the Indian market and reach these cities and expand their consumer base in the Indian country or in the Indian territory, you can say. All right, so that's why I had used the word entry here. Okay, but as we can say that in the BRA 1949, it was clearly provided that no bank is allowed to operate in Indian territory until or unless it has the license. All right, whether it's a payment bank, it's a small finance bank, commercial bank, cooperative bank, whatever the bank it is. If the bank does not have the license, the bank will not allow to operate in India, right? So that's why the foreign banks also required a license so that they could enter in India and operate in India. Okay, so for this, the first step is the application submission. Okay, foreign bank interested in operating in India must initiate the process by submitting a formal application to the Reserve Bank of India. This application is a crucial first step and should include comprehensive details about the bank's intention and capabilities in India. All right, so we can say, suppose, just take an example. If we have a bank XYZ, the bank belong to the UAE, United Arab Emirates, or you can say belong to the Dubai. All right, and this bank wants the entry in the Indian territory. We are just taking the example. They want entry into the Indian territory. Okay, for this, they had to take a permission from the Reserve Bank of India, because as we know that the Reserve Bank of India is the chief regulatory authority. All right, thereafter, they had to submit a draft, and this draft is called the application. Okay, in application, the first major step is called intention. The first major step is the intention. Okay, like what is the intention of the bank behind settling in the Indian territory? Okay, whether it's a customer base, okay, whether it's expansion of business, whether it's a funding, all right, whatever the motive behind establishing in India, they have to state it right in the document. Okay, second thing is the capability. All right, like they had to convince the Reserve Bank of India that we are coming to satisfy the capabilities. Suppose, just an example. Let me give you another example. This is you. This is me. Okay. This is my company XYZ. Okay. You have come to me and you ask me the permission to come into the XYZ. All right. So, is I'm allowing you to come there? No, I will take some steps. It means that first I will give the application form to share me the information about you. Thereafter, I will take the interview. Okay, to check out that whether you are capable or beneficial for my company or not. Okay, similar things. Okay, similar things happen with the banks. All right. In such case, in the banking terms, the interviewer means me is the RBI, and you, the interview basically is the foreign bank. Okay, so not only they have to convince the RBI that we are beneficial for the country, all right, but also like if you ever given your job interview, then you might be asked that what is your reason behind coming to this country, right? The similar thing will be asked to them, like what is your motive behind establishing India? First thing. Second, how you are beneficial for India. Third, if the RBI gets satisfied, then only the license will be granted and the bank could enter in Indian territory. All right. So I hope that the first point is very much clear to you. The application typically covers information related to the bank's ownership structure, financial stability, track record, governance framework, and the purpose scope of operation in India. Okay. These all details like who owns the bank. All right. Financial stability, track record, governance framework, and the purpose of operations. All right. Now, this is a point I would like to explain a little bit. All right. So, if we go by the section 8 of BRA, the section 8 satisfies the one thing. What was that thing? The section 8 states that there is a prohibition on trading. Okay, it means that the bank could not enter into the trading. All right, and even the bank are not allowed to maintain any kind of interesting relationship with any entity which is involved in the field of trading. All right, means by purchasing the stakes or by inviting the investment in the bank. All right, so similar thing also applicable on the foreign banks. Okay, suppose if we had a bank called XYZ, okay, which is trying to enter in the Indian market. Okay, XYZ has the ownership accountability for ABC. Okay, means the ABC is the owner of XYZ, and the ABC is basically the trading company. Now, in such a case, the ABC having the interest or even the XYZ having the interest in the ABC, okay, which is prohibited under the section 8 of BRA. Okay, so in such a scenario, there are high chances that the Reserve Bank of India will not allow the XYZ to come to the Indian market. Okay, because in India, we has the BRA and the BRA states that under the section 8, if the bank is involving in the trade activities or is connected with any entities which is involved in the trading activities, it is prohibited. All right. So might be the licensing request or the application of the XYZ will be rejected. Got it? Thereafter, the financial stability, track record, and the governance framework. Okay. Second step is the evaluation. Like XYZ, which belongs to Dubai, had submitted their application. All right, they had provided the documents, the information, and all the things required. Now it's a duty of the Reserve Bank of India to evaluate their request. Okay, so this is start with the RBI evaluates each application on a case-by-case basis, taking into account various factors to ensure the suitability and credibility of the foreign bank. These factors may include, the first is the reputation. Okay, RBI assesses the foreign bank's reputation in the global banking industry. Bank and reputable bank is more likely to receive approval. Okay, it means that reputation totally depends upon the past records. Like what has been the performance of that particular bank in the past years. For example, suppose there are two conditions. The first condition is the good condition. Okay, this is the bank XYZ. The bank lies in Dubai. Okay, they want the permission in India. Got it? So they apply in India and they has to get the approval from the Reserve Bank of India. This process is ongoing. Okay, so when the RBI will evaluate the reputation, it will see that whether other countries, or you can say whether in the other countries the XYZ has branches. All right, so it is fine that the XYZ having the branches in the countries like Latvia, okay, Lithuania, and you can say even in the Australia. So they having their branches in the other countries as well. Okay. And when RBI review their branches in other countries and their you can say code of conduct, RBI finds out that in these countries the bank having the good track record. It means that this bank could also be beneficial for India. All right. So there are high chances that the RBI will approve the request. The second case is the bad case. What do you mean by the bad case? In the countries of Latvia, Lithuania, and the Australia, the other countries where the XYZ has their branches. In these countries, the bank was defaulted, got bankrupt, become insolvent. Okay, if such kind of track record the bank has, it means that its reputation will be low, or you can say low reputation. Got it? It means the Reserve Bank of India will not easily provide the approval to that bank. Okay. So the first factor include is the reputation, like how is your past records, okay, in the global banking industry. Second is the capital adequacy. The Reserve Bank of India evaluates the bank's financial stability, capital adequacy, and ability to maintain its obligation to depositors and other stakeholders. Okay, this is done to check the financial benefits of the bank. Like, however, the bank having a good reputation in the global banking market. Okay, it's the first step. Second step is that the financial benefit. Okay, if the bank is not financially stable, if the capital adequacy is not meeting, if in India in the future the bank will not be able to meet its obligation to the depositors and the stakeholders, in such a case the RBI will not allow the approval, because the RBI says you might be beneficial for the other countries but not for the India. Okay, so in such cases the license application could be rejected. The third is the compliance commitment. Okay, the foreign banks must demonstrate a strong commitment to complying with Indian banking regulations, including the Banking Regulation Act 1949 and other relevant laws. Okay, it means their commitment and their promissories must be attached with the application form. Okay, so that the Reserve Bank of India could be satisfied that that particular bank will follow the Indian law and order, Indian rules and regulations, and will work as per the Indian economy requirements in the nearby future, rather than working on the requirements of their home country from they belong. Okay, for example, if we take example of the XYZ, the XYZ now belongs to the USA and now they are working in India. In India, there is a condition that the money supply should be reduced. But in USA, money supply should be increased. Okay, these two conditions belong to these two different places. So the XYZ has to act independently. Okay, it is not allowed that instead of reducing the money supply, the XYZ is increasing the money supply as per the requirements of the home country. This comes under the compliance commitment. It means that if the XYZ is doing opposite to the orders provided by the Indian agencies while working in India, that will be considered as a violation of Indian rules and regulations. Okay, and that is not allowed. Third step is the approval and licensing. First, application submit. Second, evaluate has been done. Now the approval and licensing. If the RBI satisfied with the information provided in the application and believes that the foreign bank meets the regulatory criteria, grants approval for the establishment of a branch or subsidiaries in India. Okay, if everything is fine, all right, each value, each commitment, all right, and the past record of the bank is fine, it means that the Reserve Bank of India could allow that particular foreign bank to start the business in India. Okay, there is no restrictions there, but they have to be obedient to the Indian rules and regulations as per the BRA and as per the regulatory authorities. Got it? The approval indicates that the foreign bank has met the prerequisites to operate in India and has been granted a license to conduct banking operations within the country. Okay, it means that the test has been passed. Okay, now second one, after the establishment comes the regulatory compliance. Okay, regulatory compliance is a critical aspect of foreign banks operating in India. Banks are required to adhere to a comprehensive set of rules, regulations, and guidelines prescribed by the Reserve Bank of India and other relevant Indian authorities to ensure the stability and integrity of the Indian banking sector. It means that doesn't matter whatever the capital requirements, economy requirements, other banking or financial requirements in the home country of the foreign bank. While working in India or while operating in India, the foreign bank is restricted to do as the Indian market demands. Okay, they are not allowed to do what their domestic market allows. All right, so that's why the regulatory compliance is a necessary rule. And for this, the RBI having some things. Okay, so the first thing is the capital adequacy. All right, so the foreign banks operating in India must maintain adequate capital levels to absorb potential losses and ensure financial stability. Capital adequacy norms are set by the RBI in line with international standards, typically following the Basel III framework. All right. So if we talk about this in little bit detail, then we can say in India, the banks are required to maintain a sufficient reserve with them in order to meet their obligation. Like for private banks, it is instructed that these banks must maintain at least rupees 500 billions at all time. Okay. In case of 5 billion, sorry. 5 billion at all times. Okay. In case of meeting their obligations, or we can call it 500 crores. Okay. Second one is the scheduled banks. For scheduled bank, it is instructed that at least rupees 5 lakhs must be maintained at all time. Okay. For payment banks, it is instructed that at least rupees 100 crores must be held by the bank at every time. For SFB, it is instructed to maintain rupees 100 crores at all time, right? This is the minimum capital adequacy. Okay, it means that this is the reserve the bank has to maintain at all time in order to meet the unforeseen circumstances. Okay, similar thing also applicable on the foreign banks. Okay, like the foreign banks are basically required to maintain the USDs 25 million. Here USD stands for the United States dollar. Okay, it means the foreign banks has to maintain the $25 million at every point of time. Okay, and even this is the minimum capital requirement while establishing or entering in India. Okay, so this is the capital adequacy. Got it? For the foreign bank. Second thing we had noticed here is the Basel III framework. What do you mean by it? Now try to understand it. Okay, it is important from the banking perspective that you must be aware about the Basel III agreement or framework. So the Basel III was basically introduced after global crisis of 2008. Okay, in 2008 there was a global crisis across the world when the major banks of the world were collapsing one after one. Okay, and this was happening in just a month, in matter of months and years, Because of this, the liquidity, and you can say because of this, the banking sphere of the world was disturbed badly. All right. And thereafter, it was felt that there should be a regulatory framework to maintain a sufficient reserve with the banks in order to meet the unforeseen circumstances in the future. All right. That's why Basel III agreement was introduced in the year of 2008. Okay, to meet the global crisis of 2008. Got it? So in the Basel III agreement, it was required that at least 7% of capital reserve must be maintained by the banks at every point of time. Okay, on the basis of risk weighted ratio, or you can say in the basis of asset and the risk weighted ratio. Okay, the limit is the 7%. Prior to this, the limit was nearly about 2 to 3%. Okay, it means whatever capital reserve the bank has, at least 7% of it must be maintained by the bank at every point of time. All right, on the basis of asset to risk management ratio. All right, and this is basically done for, or you can say, there are basically some measures regarding this. The first measure is maintaining the reserve. This is the first measure. All right. As I have told you, at least 7% must be maintained at every point of time on the basis of asset and risk weighted ratios. Okay. Second was to quality management. Okay. It means that when the bank is maintaining the 7% reserve, and if the bank invested this reserve, then the investment must be in a quality products. It means that at least in the gold, okay, in the land and other areas. All right. Not in a movable immovable property or not in a buying of trading goods. Okay. Because these poses a potential threat for the price drop and all. Okay. Which might reduce the value of the goods. Got it? Thereafter, the third is the risk management. Or you can say risk assessment. All right. It means that to check assets regularly. Okay. Suppose the bank having the 10,000 crores. So it means the 700 crores is the 7% of the reserve. All right. So this 7% must be invested in the quality assets. Okay. Like in the gold or silver, whatever you can say. All right. Second step is the risk assessment. It means that it is not allowed to invest the money and then sit carefully. Okay. But the bank is required to assess the value of the assets day to day. Suppose in the 2017, when the asset was purchased, it was worth rupees 700 crores. Okay. But the price is dropping frequently. Okay. And it is totally expected that by reaching the 2020, the same assets will cost at 600 crores. So there will be a lowering value of the asset. In such a case, the bank should sell out the asset on that time, recover their money and invest it in other asset. Okay. And this should be done on the regular basis so that the bank could manage the asset and the risk assessment. All right. And the third is the most important form, it is the liquidity conversion. Like in the previous lectures, I had told you, the assets in which the bank invests their reserves must be able to convert into the liquidity or in cash immediately. Okay, it should not be invested in such kind of asset which could not be sell out easily, and it means that their conversion from the physical asset to the liquidity or cost will be longer than expected. Okay, for example, let me give you an example. Suppose the bank had invested rupees 700 crores in the land, or you can say plant and machinery. Just an example. Okay, however, plant and machineries are subjected to the depreciation, so their value might be get decreased in the upcoming future. Okay, so let's remove it from here. Let's focus on land only. Okay, so suppose 700 crores has been invested in the land, all right, by the bank called ABC. Okay, after some time, in the month of April, the bank required these 700 crores to meet their obligation and to save itself becoming of bankrupt. All right. So the bank is now trying to sell out the land, but the land is a property which could not be sell out easily. Okay. It means that the bank will not be able to meet the liquidity requirement right now. Okay. And this will leads to the hindrance in the banking operations and might be to the bankruptcy of the bank because they are not able to meet their obligations right now. Okay, but if the same amount will be invested in the gold or silver, okay, so these reserves could easily sell out in the market and the physical asset could be converted into the cash easily. This will help the bank to got the required cash and meet their obligations. Okay, so this is the Basel III framework introduced in the 2008. All right, and these are the proper terms. Thereafter, these norms specify the minimum capital requirements that the foreign banks must meet, including the common equity, tier 1, and this is the tier 2. Okay, tier 1 and tier 2 capital and the total capital. All right, tier 1 capital is the invested capital. Tier 2 capital is the backup capital which could be invested whenever it's required, and this is generally unknown to the normal people. Okay, I have told you that tier 1 is the capital which has been invested initially and the information about it is available in the public, whereas tier 2 is a capital which is a secondary capital and generally kept to meet the unforeseen expenses and to meet the time requirements, but this capital information is not available with the normal people. Okay. Thereafter, compliance with these norms is essential to safeguard the interests of depositors and the stakeholders. Second one is the asset quality. Foreign banks are required to maintain a high quality loan portfolio and manage credit risks effectively. They must classify assets based on the quality and adherence to the Reserve Bank of India guidelines on asset classification, provision, and non-performing assets. Okay. Ensuring the quality of assets and promptly addressing NPAs is essential to maintain financial stability and protect depositors' funds. Asset is basically the loan and the investments made by the bank. So the foreign banks must ensure that to whom they are providing the loan or making the investment, that particular asset should be the quality asset. Okay, like if they are providing the loan to the person who having a past record of defaultness, okay, then this is a risky asset, not a good quality asset. Okay, and this could be converted into the NPA in the nearby future. Okay, so that kind of things has to be ensured by the foreign banks. Thereafter, the liquidity management. Foreign banks must implement robust liquidity risk management practice. RBI sets guidelines to ensure that the banks maintain adequate liquidity to meet their obligations and manage short-term funding mismatches. All right, it means that they must carry the cash requirements with them to manage the immediate requirements occurs in before. Okay. These guidelines help prevent liquidity crisis and ensure that the foreign banks can continue to provide banking services without depressions. Corporate governance. Sound corporate governance is crucial for foreign banks. About corporate governance, we have a lecture in the upcoming lectures so that we could understand it on that part. But right now, I'm just trying to telling you, just grasp the fact. Okay. Must establish effective governance structures, including board of directors and the risk management committees to oversee their operations. Okay. Corporate governance stands ensure transparency, accountability, responsible decision making within the bank. Okay, it means that the leadership of particular foreign banks must be sounded, must be adequate, and must be capable to ensure the smooth functioning, effective functioning, efficient functioning of the bank within the Indian territory and for the Indian customers. Thereafter, compliance with the Indian laws and regulations. Foreign banks operating in India must comply with all relevant Indian laws and regulations, includes the Banking Regulation Act 1949, Foreign Exchange Management Act FEMA, among others. About FEMA also we have a separate lecture. Okay. Compliance with Indian laws is essential to ensure that the foreign banks operate within the legal framework of the country. Okay. Thereafter, reporting and disclosure like the auditing and the inspection provision. Foreign banks required to submit periodic reports, disclosures to the Reserve Bank of India and other relevant authorities. These reports provide information on the bank's financial performance, risk exposures, compliance with regulatory norms. It means that whatever the audit, whether the statutory or the internal, whatever the inspections done by the foreign banks to assess their internal stability and their current situation or current scenario, these reports must be closed with the Reserve Bank of India and the other relevant authorities to forming out the clear-cut picture about the bank's financial stability. Okay. Transparency through reporting and disclosures helps regulators and authorities monitor foreign banks' operations effectively. Okay. Thereafter, the ongoing supervision. The RBI actively supervises the foreign banks' operation in India through regular inspections, audit, and assessments. Supervision ensures that the foreign banks continue to comply with regulatory requirements and maintain the financial stability. RBI may issue guidelines and directives as needed to ensure compliance with the evolving regulatory standards. Alright. So students, basically in this lecture, we have completed some facts and figures written with the foreign banks in India. Okay. In the next lecture, we will continue with the same topic and we will try to cover some more facts and figures. Till then, just revise this topic carefully and be ready for the another lecture. Okay. With this note, let's end this lecture and thank you.